welcome back to our lessons for today. Yeah. So what we're going to look for today is on ledgers. Ready, set, go. Now, we all know our accounting steps starts with a piece of paper known as our document, our business documents. Okay, you see all the details, who sent to who, and how much does it cost. And when you receive a business document, you will record it into your first line of bookkeeping, known as our books of prime entry. Okay, so books of prime or original entry. We have our journals, our cash book, and our petty cash book. Now, this is done daily. Towards the end of the month, it is time to calculate how much is actually our sales like. How much things have we purchased? How much things are we owing to people? And how much people are owing to us? Or how much our bank balance left? How much is our cash balance in hand left? How to know that? That is a process where we will classify things into its specific groups of accounts in a place called ledger. A ledger is a page or pages of T-shaped account. Okay, so this is ledger. Normally towards the end of the month. And this is the time of the month where you will see accountants, or let's say if it is business owner who does business alone, sole proprietor to be exact, you'll be seeing them non-stop hitting the buttons of the calculator to calculate how much is their sales, purchases, income, expenses, etc. So this is where the ledger plays in. Okay, so with traditional methods, a ledger is also another book. This is the second book. Okay, it's normally a very long book. This is ledger. Okay, in the popular bookshops, you'll be seeing ledger books. So we have book of prime entry and we also have ledger books. So normally you do this at the end of the month where there will be something amount over here and an amount over there. Okay, so let's see how ledger looks like. So a ledger is a T-shaped account. Normally we use T-shape, although there's another different kind of shape called the columnar shape. Okay, we have a debit known as BR in short. This means the left hand side. And then we also have the right hand side area where we have our credit. Okay, at the end of the month, we will classify and group the figures into its specific groups of account. Okay, so normally we will say there will be a debit of something and a credit of something. What is this means? It's like a give and take process, something like that. Debit and the credit is like something that goes in and goes out. It's something like an in, out, give, take kind of thing. This debit and credit is known as double entry. When we record the transaction, there must be a left side and another person will be on the right side, that kind of thing. There will be always a pair because this concept is developed by our father of accounting called Luca Pacioli. You can Google that up. Okay, Luca Pacioli. So our ledger has two parts. Normally on the debit side, we have the recording of assets. What kind of assets? There's a lot. There's many kind of assets. We also have our expenses here mainly as well. You group them on the debit side. There's many kinds of expenses as well. Liability. A lot of liabilities. We also have our income over here. And then we also have our capital portion. Now notice there will be a left hand side and right hand side. And in earlier topic, you have learned asset is equals to liability plus capital, which means debit side must be equivalent to your credit side, in which case both sides must be backwards. Okay, I give you an example. Okay, let's say the transaction was cash sales of $1,000 on January 2. So First step is we will go through the document. So there must be a receipt made. Okay, there's a receipt in transactions. So we will record this transaction, the cash sales, into our cash book. In the cash book, a cash on the debit side, we will record as money comes in. Okay, this is the books of prime entry. So still remember that our cash book is also a kind of ledger because it's a T shape. So cash, let's just focus on the cash account portion instead. So let's open. This is our cash book, the cash account portion. Okay, you have cash account. Okay, so this is our debit side and the credit side. So dollar sign will be over here, as you all know. Let's say this is on the this year, 2025 then. So the date will be over here, date's over here. Now, on January 1, okay, we have a cash balance brought down, meaning December 31, 2024, the balance left during that month, we bring over to the next day, to a new month. That is called a balance brought down. Okay, balance BD, let's say we have 100 over here. Okay, so cash sales means we make money. So cash increase. Okay, so cash increase. On January 2, there's a cash increase of 1,000. Now, what is it for? Cash sales. So there is a sales. So we put a sales. Okay. Now let me change this to another amount, another color. Let's put it as a red color on. Okay. A red color sales. So cash account is being debited in this sense. So we say we debit our cash. Means money comes in. Okay, 1,000. So we cannot left this transaction hanging because one side is receiving. And then what about the other side? What about the credit part? Now, what has happened? A sales. What is a sales? A kind of what? A kind of income. So you see, our cash is an asset, right? Once it is being plus, once it's increased, we say we debit that particular thing. Because asset by nature is situated at the debit side. So once you increase it, we say we debit it. Okay, same side increase, then you say which side it is increased. What side? In this case, asset is increased, so we debit that particular asset. Which asset? Cash. We know asset is equal to liability plus capital, meaning the debit side must equal to the credit side. So on credit side, what happens? We see a sales happen. A sales is a type of a income. So income happens, right? So meaning income increases. So therefore, we credit the income account. Which kind of income account? A sales account. So let's open up a sales account then. Okay, debit credit, debit credit. Now let's say our sales account has on January 1, a balance brought down of also another 100. Okay, means last month the sales happened was 100. So it brings forward to this month again. Okay, as a new balance. So this month happened a cash sales. Now cash account, let me change the cash word into another different color. Let's say I make it a brown color, green color. Cash account. So since income increases, so we credit on the right side, we go up as well. Okay, so means income is being credited, so sales is being credited by cash of 1,000. So notice it is balanced both sides on the both end. Cash account is being debited, so somebody has to be credited. So sales is actually referring to our income. It also can refer to our inventory. Inventory by nature is an asset. So once it's being go out, we say we credit. Only for asset you can say like that. Once something go out, we credit. Something go up, we debit. Okay? So sales account is a kind of a income portion. So once we credit it, means we increase that particular side with this. Then let's say it's the end of the month, we will close the account. But before that, we say credit the sales. Sales increase. by 1,000. Now, at the end of the day, let's say it's the end of the month, so we close the accounts. So cash account here is 1,100. So this side on the credit side must be also 1,100 because an account must be both side balance. So here 1,001, we put January 31. We call it balance carry down. Why? Because you're going to carry it downwards to the next month, which is February 1. Balance brought down 1,100. So on February 1, you have $1,100 cash in your hands. For sales, okay, 1,100. Both sides must be equal. Balance carry down. Bring it to February 1. Balance brought down 1,100. This means that during the month of January, we have made a sales of, there's an increment of 1,000. So our sales to now, to date, for this month, at the moment, we have made sales totaling up to 1,001. Then we bring it to the next day as a fresh beginning. Okay, until the end of the accounting period, which is a 12-month period. So maybe this January, well, we don't say this January will be our January to December. Let's say this is December to November kind of thing. Okay, so November 1, December 1 as our beginning, and then November 30 as our ending after 12 months. Okay. Now, if let's say both sides decrease. Okay. Now let's see. Another one more sample, then we end. Second sample. Let's say we pay ABC supplies with check $2,500. Again, this will go into our cash book. But once we see check, we need to immediately think of our bank. Okay, bank at the cash book will be reduced. Okay, so means we credit our cash book under bank column. So that will mean our bank account. So bank account, the debit side, credit side. Let's say this happened on January 5. Okay. As per January 1, let's say our bank balance have a balance brought down of $500. And then we pay money. Okay, let me change it because I do not want to make a bank overdraft. Let's say we have 4,005. Now, once we pay money, means bank go out. Bank go out. Okay, our asset goes out. Once our asset goes out, being minus means we are going to the opposite side. So that's why in our cash book, we credit the bank account with 2,500 on January 5. For what is it for? Okay, we know ABC supply will be our trade payables, which is our liability. But what we're going to write here as our detail, we're going to write the name of supplier. Okay, supplier or customers, we're going to record their name as the detail. Okay, not the word trade payable or the word trade receivables. No, we will record their name as long as it's not our name, other people's name. So we write ABC supplies 2005. Okay, let's change to a different color. For this, I put ABC supplies. Now, bank is credited. So what to debit then? Just now, who we wrote, what items that we write on? We wrote ABC supplies. So once the bank account is credited with ABC supply, therefore ABC supply will be debited. This is how it works. So we write ABC supplies. So let's say as January 1, brought down from last month, we still owing ABC supplies worth 3,500. Okay, so now we pay our supplier. So means our liability reduces. So once our liability reduces, we will go to the opposite side, in which we will debit that particular liability. So here will be the item. On January 5, we debit that particular account with the bank. So we will debit the bank. Okay? Debit the ABC suppliers with the word bank. Okay? So you notice that both sides, on the bank account, if ABC applies on supplies appears on its credit side, then in ABC supplies, the bank will appear on its debit side. You guys can see that? And that's how it is. So therefore, we close the accounts. So bank account, which side is bigger? The debit side is bigger. So we close the account with the side that has the bigger amount as the amount in both sides. So money has go out 2005. So how much money left in the bank balance, in the bank account? So we have balance of 2000 at the end of the month of January. Balance carried down, and then you bring it to tomorrow, as in the next month, the first day, we'll have a balance brought down 2000. As for ABC supply, this is how we interpret. Okay, so which side has the biggest amount? Okay, the credit side has the biggest amount. So both sides will be written with the value that is the highest one. So meaning the debit side has a balance of 1000. So we bring down to the next day, the next month, balance brought down 1000. This means that we still owe ABC supplies 1000 bucks, because just now 2005 is just a portion of it, of our debt we have paid. We still left with 1000 bucks as our debt to the ABC supplies. Okay, so this is how ledger works. So there's many kinds of individual accounts. Okay, so these are the main group. Each of these group has many key accounts. So our ledger book can be pages and pages and pages long with different groups of accounts. Okay, so this is how ledgers work. Okay, so very simple ones are here, and later on we'll be discussing more in our class with the relevant exercises. Okay, so that's all for today. Alwin Kwan here from TTC, signing off, and see you in our next video. Bye.